For the past decade, traditional banks have mastered a quiet, invisible tactic to starve their digital competitors. It is called debanking. Rather than trying to out-innovate emerging financial platforms, legacy institutions simply close their accounts and cut off their access to the fiat money supply. The results are immediate. Startups lose their core processing partnerships, customer funds are frozen, and meeting basic payroll becomes impossible. The promise of a borderless, decentralized economy remains trapped as long as legacy gatekeepers control the exit doors. But while traditional banks block digital challengers from using legacy rails, they are actively moving their own balance sheets onto digital ledgers. JP Morgan, led by CEO Jamie Dimon, has built its own blockchain network to settle trades internally. Meanwhile, BlackRock, under Larry Fink's direction, has moved aggressively to tokenize hundreds of millions of dollars in treasury funds. Even the core infrastructure of the market, the New York Stock Exchange, is piloting systems to settle traditional securities on distributed networks. They are engaging in real-world asset tokenization, taking physical or traditional financial assets and issuing programmable digital representations of them on a blockchain. Once incumbents rely on these ledgers for their own core assets, shutting down the network stops being a weapon and becomes a mutual liability. With physical assets converted into programmable tokens on networks like Ethereum or Solana, the reliance on a central bank to route value disappears. This chart shows the exponential growth of real-world assets moving on-chain, reaching a total of $32 billion, spread across treasuries, private credit, and commodities. These tokenized assets trade continuously, day and night, ignoring the closing bells of traditional exchanges and bypassing geographical borders entirely. When the asset itself functions as the payment rail, you no longer need a legacy correspondent bank to approve the transfer. Moving assets on-chain solves the transfer problem, but converting digital assets back into everyday fiat currency still requires touching a traditional bank account. To fix this, digital currency issuers like Circle applied for national trust bank charters, effectively building their own federally regulated captive banks to hold cash reserves. Instead of asking legacy banks for an account that could be closed at any time, these companies sought the regulatory authority to custody assets themselves. Securing sovereign regulatory status brings the fiat bridge in-house, permanently stripping legacy banks of their ability to veto digital transactions. SigmaBankAI combines these strategies into a single platform, engineered specifically for a financial system where debanking is a constant threat. The foundation is a compliant offshore digital merchant neobank. Above sits an AI compliance engine, continuously monitoring transactions and rebalancing liquidity in real time. The top layer connects these reserves to global tokenized markets, instantly converting real-world assets into fiat liquidity. By embedding a sovereign captive bank infrastructure directly into the Web3 tech stack, SigmaBankAI bypasses third-party legacy bottlenecks entirely. Consider a cross-border e-commerce merchant attempting to expand into a new region, only to have her traditional bank freeze her account due to broad, automated geographic risk policies. If she transitions to the Sigma IMIN ecosystem, she plugs in as an integrated, self-sovereign node on the network. Her business treasury is held in tokenized real-world assets, while Sigma's AI continuously prices her collateral to provide dynamic credit lines. Even if traditional markets experience sudden volatility or correspondent banks halt processing, her supplier payouts and yield generation continue without interruption over stablecoin rails. She is no longer a fragile endpoint in a legacy banking chain, but a self-sustaining entity insulated from outside freezing tactics. Scaling that concept up, the IMIN ecosystem becomes a dense web of these individual merchants, creators, and investors. Every new user that joins plugs their assets into a shared, federated liquidity pool that strengthens the entire network. Unlike traditional banking, which isolates users into centralized silos, this community-driven model entangles assets across a broad network. You cannot isolate a single node without dealing with the collective. Legacy gatekeepers lose their power when you stop relying on their infrastructure. Secure your liquidity and command your financial future. SigmaBank.ai. I'm in. Are you?